It's been snowing here in New York and has been a freezing adjustment for me after coming back from Miami, but I'm loving it. Today, I'm going to respond to many of you who have been asking me about the future of the Swiss franc after its jaw-dropping moves on January 15th. From the city that loves to trade, my name is Kenna Danielle with Investiva, and this is your Swissy special on the Forex Dance Floor. The Swiss franc has historically been considered a safe haven currency with virtually zero inflation backed by gold reserves. From 2011 to 2014, we saw important decisions made on the value of Mr. Swiss franc. What happened is that in March 2011, the dollar Swissy dropped past the 0.91 level because investors were looking for safety with the continuation of the Greek sovereign debt crisis. By August 2011, the pair passed below 0.769, and that's when the Swiss National Bank decided to boost Mr. Franc's liquidity to counter its humongous overvaluation. Meanwhile, in a different Forex dance floor where Mr. Swissy was dancing against Ms. Euro, the pair appeared to be heading to parity. So the SNB had to get all serious and set a cap for the pair's movements. That meant that they won't let the Euro-Swissy pair dance below the exchange rate of 120. This cap continued until the historical Thursday on January 15th, 2015, when the Swiss National Bank suddenly got rid of the cap and Mr. Franc increased by 30% in value compared with the euro in just a few minutes. The distance they danced in those few minutes was more than they had moved collectively in the past 1,000+ days. The effect? Quite a few. The key Swiss interest rate was lowered from -0.25% to -0.75%. Investors would be paying an increased fee to keep their funds in a Swiss account. The valuation of the euro against the franc is expected to hurt Switzerland's export industry. And last but not least, many forex brokers face troubles. Taking a look at the Forex dance floor, Ms. USA has been strong enough to pull the dollar Swissy pair back up to the 0.93 level above the Ichimoku cloud after the cap removal. But with the euro remaining in a weak position, the Euro-Swissy pair hasn't seen much rebound. In the long run, we could see the Euro-Swissy pair to settle at one of the key three levels: 0.90, 1.0, and 1.10. The higher the rate, the better the forecast for Swiss economy, but still both the GDP and inflation would remain below their healthy level. Even though one of the reasons why the SNB ended the peg was the hot political topic in Switzerland, where the Swiss were scared of hyperinflation, Swiss inflation is actually too low, not too high. That's why we might actually see a Swiss intervention to devalue Mr. Franc again. A cheaper franc boosts exports to America and India, which together makes up about 20% of Swiss exports. That's all the important stuff you needed to know about Mr. Swissy on the Forex dance floor. And as always, if you like this video, like it and share it with your friends. To get our latest updates, subscribe on Investiva.com and follow us on our social media. Invest responsibly, and don't forget that only you can take care of your money the way it needs to be taken care of. So, get yourself educated.